Good afternoon from Lagos. Hello, good morning, DC. Ladies and gentlemen, my name is Baba Alukolaro, Managing Partner of TMP, one of your 5 hosts this afternoon. Let me welcome you to Andersen's 2026 Global Economic Outlook. This is being hosted by the 5 Andersen firms in Nigeria, which I refer to as Andersen's 5 fingers. One firm, multiple competencies. Taking a look at the end of last year, specifically Q4, starting 1st October, I hosted a number of public figures at an evening in celebration of Nigeria's independence. We had political figures as well as business leaders. And the theme or the crux of our conversation was the hope of the present Nigeria as the year was ending. We had come from a position a couple of years ago where there was significant doubt as to where the economy was heading. There was instability with our currency, and we weren't exactly sure where the economy was going. And we reached a position where the above average Nigerian could predict, those are the business people, the currency had somewhat stabilized, and we could all begin to plan. We'd moved from a position where we all had to hedge on the dollar and moving our savings from NGN to USD to where we were now swapping USD into NGN and making investments in local currency. Around the same period, or just before then, we had a new sheriff in town in the United States of America. And by the end of the year, we found a situation where a country in Southern America had its president picked up and taken to the USA to be prosecuted. We started a new year, 2026, and it's pertinent for us to know which direction the world is going, and as well as the way and manner it affects our continent, regionally as Africa, and Nigeria. So what we've done as Andersen, as we are wont to do, bring in our specialists, bring up a think tank, look at exactly what the world pretends, what we are looking at vis-a-vis the future for the year. Can we plan? Are we able or unable to plan? What are the tariffs that are being screamed about from the US? How will it affect us regionally as a force in Africa? Will it affect us as a country, Nigeria? And are our businesses able to plan going forward for the year? So what we've done is we've called none other than an economist that has significant experience from an institution Nigerians are very familiar with, or may not be extremely popular with the Nigerian populace. He's had experience with the US Treasury, experience with the IMF, and most significantly, he's the CEO of Andersen's Institute for Finance and Economics. This is Fabio Natalucci. Fabio will be taking us through his thoughts and data with statistics on the economic outlook, Andersen's economic outlook for 2026. Thank you very much, ladies and gentlemen. I will hand over to Fabio at this point. Thank you.
Thank you very much for the kind words. It's really a pleasure to be here. I'm very happy to be able to contribute to the discussion and bring the work, share with you some of the work we have been doing at the Institute in terms of the forces that are driving the global economy and financial markets. So what I'm going to try to do, I thought about how to structure this. I'm going to have no slides. I'm just going to try to walk you through what I think are the forces that you need to focus on in 2026 and beyond, trying to explain you why these forces are relevant and how they're relevant, not just when we think about the macroeconomy and global market, but also for individual decision-making at the firm level, at the level of policy-making, as well as for individual financial markets participants. I think the starting point, we can start from the IMF release of the update of the World Economic Outlook in January 26. The number for 2026 expected by the Fund for Global Economy are 3.3% and 3.2% in 2027. and 2024 was 3.3. So it's about very little change numbers in January 26 vis-a-vis last year, but also very little change in numbers across the next couple of years. But I think the message I want to take home, I want to highlight here is that underneath the hood, there's a lot of forces pushing in different directions. And what is new here is that we have forces that it's a number of structural forces. This is beyond the short-term couple of years conjuncture. Those are forces that are changing the way the global economy works, the way global trade, global finance. And what is unique here is a couple of things. One, they're all occurring at the same time, right? And I'm going to be focusing on a couple of these. One is geoeconomics. So all these geopolitical tensions, how this is rewriting the world international trade, how we're moving away from international cooperation as embedded by the role that the fund, the IMF, for example, plays. The second forces that I'm going to be focusing on is innovation and AI. People have different views on what do we see in the data in terms of productivity. I'm just going to tell you a little bit more how to think about this, why this is relevant, not just, again, for calculating productivity at the global economy level, but also at the individual decision-making level. And then the third force I'm going to be focusing on briefly is digital finance, how the world of finance is being completely changed by the new Bitcoin technology, the digital ledger technology, and how we should think not just about Bitcoin, but there's way more than that. Bitcoin often hit the headlines, but there is a world of stablecoin and payment system modernization and also tokenization of asset of finance more generally. What is unique here that again, that these are all happening at the same time. Usually those are forces that will happen once in a century, a couple of times in a century. They're all happening now. And then the second feature that is very unique, I think, is that they are the center of origin of some of these disruptive forces are the United States. And the United States, which is the country that benefited mostly from the traditional world order that was established after World War II. If you think about the share that US firms have of global profit, we're talking about 40, 50% of that share. The role of like market economy, how it has expanded across the world, and also liberal democracies. So what is unique here is that all these forces, all this trigger, this impetus to change, this innovation is coming from the US. Whether this is about the rewriting the rules of international trade and finance, whether this is innovation and AI. When you talk about AI, you talk about Silicon Valley. And when you talk about digital finance, again, with the passage of the Genius Act in the US and the US embracing essentially digital technology. So those are the three major forces I'm going to be focusing on. When I talk about, just to clarify here, I'm not going to be just discussing trade policy and tariffs. I know there's a lot of focus on there. I'm going to say a few words there, but I think this is much broader than tariffs per se. This is about what we call mercantilist policies. This is about the role that the government plays in the economy across a number of fields, not just trade, but it's pertain, for example, of the actual participation and management of government of the economy. Think about the US administration, the US government taking actually an equity share into Intel, or the US government taking warrants in specific companies. So the whole array of industrial policies from minerals, rare earth, AI that have been put in place in this country, that if you just look back a few years, they're quite unprecedented in some sense. So that's what I'm going to referring to. And then AI and what's happening in that space. I think in terms of, and a lot of my discussion at the beginning going to be focused on United States for an obvious reason. One is because they're originating here and some of these changes are starting from the US and propagating like a wave outside of the US. And I'm going to end say something, what does it mean for emerging markets toward the end. In terms of like growth, all these two forces, so mercantilist policies and AI are propelling the US expansion forward. If you think about what mercantilist policy essentially as a macroeconomist means more fiscal policy, right? This fiscal policy in terms of defense spending, in terms of industrial policy, in terms of any form of policy that's been put in place to shift the economy toward a more domestically oriented, self-sufficient, resilient, and engagement of the government in the management of the economy. So that's going to be a plus. It's going to be continue to push and support the economic growth. It's not just a US story. Just look at Europe, the Munich Securities Conference, and now Europe essentially has stated now that they need to start rearming And to do that, they need to fund themselves, which means I just published an op-ed on MarketWatch today with a European colleague where we say that if you think about all the initiatives that are going to be put in place in Europe, they might count to something between 1 and 1.5 trillion euro bonds. So mutualized issuance, that will create a very significant, larger competitor to the US Treasury market. So that's just an example. And then the second piece that is going to push the US economy forward in the next few quarters is going to be CapEx for AI, investment in capital for AI, and that continue to grow exponentially, continue to reshape the economy. You can just think about the hyperscaler. They invested $400 billion last year. The number that have come out more recently are for this year, the estimate are at least 650 billion. What is unique of that investment, it's a very interest rate insensitive. So it's not really linked like traditional CapEx to where interest rates are. If the Fed tighten, usually investments slow down. This capital investment, it's an existential investment to continue to be at the frontier of technology, and it continues no matter what. And I'll come back to the financing of that part and what it means for financial markets. Now, what this is generated is what economists have called the K-shaped economy or misshapen economy. That means that the benefits of this growth are accruing to one part, specifically the upper part of the income distribution, but less so to the lower part of the income distribution. If you look at CapEx data center, for example, build out, they don't employ many workers. The participation, the share of workers in those kind of investment is much smaller than traditional investment. And the workers invested in data center tends to be more localized, more hyper specialized in specific sector, and so it doesn't seem to flow through the broader sector. The second piece is that investment is going to be inflationary. It's going to start putting upward pressure on anything that comes from the physical world inside into this investment, right? So think about the chips. What this means in terms of electricity, in terms of pay for highly skilled workers. And this is happening on the back of walking away from globalization. And so all the forces that actually help reduce inflation globally, essentially since the entry of China in WTO in the early 2000s, those forces are in retreat. So we already are a backdrop where, because everyone is trying to build a more self-sufficient, domestically focused economy, think about supply chain, for example, that means that likely that these inflationary forces that actually helped keep inflation low post 2000, those forces are going away. That tension between this, what we call the K-shaped economy, it's also visible in the aggregate number, right? So if you look at the US economy, it's growing very fast in terms of GDP, but then we have seen, particularly after the new benchmark in the US, that actually growth has been relatively small last year. We're talking about 400,000 jobs for the entire year. That means about 300 jobs per state. So those are very small number per month. Now, what are the risks around this outlook for the US? One is that we have both fiscal and monetary policy. They are relatively accommodated, right? So if you look at the fiscal deficit in the US, it's very large. If you look at where monetary policy is, I would argue that seen through the lens of financial markets, actually monetary financial condition continues to be very accommodative. And so one of the risks that has been discussed a lot is whether there's a bubble, particularly related to AI in financial markets, right? If you look at record high level of equity valuation, investment grade bonds are very, very tight by historical standard, and availability of credit particularly for the corporation, it's very there. Now, from a fiscal standpoint, we're starting to hit, and this is one important macroeconomic backdrop that we have, right? We have these three forces that are highlighted, that the macroeconomic backdrop at the global level has changed. One, as I mentioned, inflation is higher than it was pre-COVID. And the second one, and everyone, not just the US, not just advanced economies, but also a number of emerging markets, are running much higher level of debt to GDP, expansionary fiscal policy. And so at some point, market will start questioning whether we're starting to reach fiscal limits. How high can countries, including a country like the US that has the global currency, if you want, at what point we're going to hit the fiscal limits? Another is to consider, and I think this is particularly important, is the political economy of AI. Think about all the questions that have been asked with how fast AI is disrupting labor markets, how it's going to replace white-collar workers, for example. So there's obviously the positive story about AI, which is efficiency, productivity, speed, opening up no limits for creativity, but there are also starting to see physical costs in the labor market, for example, and fear that there's going to be very large disruption in the labor market. And you can have two possible scenarios how AI is going to evolve. One is where the adoption of AI is going to be very wide, but AI is not going to replace jobs. It's just going to be a complement to jobs. Some jobs will go, but new jobs will be created. In that scenario, the benefits of AI will be distributed across, if you want, the distribution of the population. There's another one, though, where the labor market is going to take a significant hit. It's going to primarily, at least in the short term, substitute for jobs. That means that the benefits of AI are going to accrue to a smaller share of the population. Think about all the pushback that we see around data center and energy costs here in the US. So I think one risk that is grossly underestimated here is the impact of AI on the political economy, how this is going to be seen by population. Think about whether there is a huge pushback and whether this is going to generate, for example, populistic forces. Right? We have seen that in the US and in other countries post-COVID, and there's a risk that AI is going to generate an additional layer or angry, disconnected part of the population from the benefits that is coming from this technology. And so important question we want to ask is like, one is how much productivity AI is going to generate at the aggregate level. If you look at this forecast that a lot of the Federal Reserve, the IMF, a lot of institutions has put out, there seems to be embedded in that scenario one where productivity picks up relatively quickly. That means that it's possible in the world, in a world like that, it's possible to essentially generate a situation where the economy continues to grow, there is not much inflation, and this productivity allows essentially to benefit from all these factors. Okay, so that was one piece of the discussion. Right? Then the other piece is like, before I finish, go back to AI for a second, is the geopolitical aspect to this, right? The US has embarked in what has been called here the Donron Doctrine. Essentially, is the President Trump version of the James Monroe Doctrine of 1920s, where the US focuses on the Western Hemisphere, and it decided that essentially pushing back against, back then in the 1820s, against European colonialism and making the Western Hemisphere the sphere of influence of the United States. So this is the modern version of this. It's what people call a resource grab, both domestically, again, the role that technology, commodities price, but also internationally. We have seen a lot of headlines related to the US intervention in Venezuela, discussion about Iran now, as well as the discussion about Greenland. And so in that world, the US is pursuing a much more hemispheric strategy, much more aggressive, much more resource focused and capital grab version of that. That has huge implication for everyone else. Like I'm going to think about different areas here around the world. Think about Latin America, for example, for emerging markets, right? A lot of countries are continuing to reshaping their political landscape, aligning with US interests. This is not just Argentina, it's not Venezuela. There's been a number of elections in Latin America that has been more business oriented, more business focused, more friendly essentially to the business world, moving to the right. So that has huge implication for Latin America. The other one is Europe. Think about Europe in terms of like the relationship with the US, trade policies, the rewriting of trade policies, the impact that those have for portfolio flows. If you look at portfolio flows in the US, for example, about 40% of global profits for US firms come from the rest of the world and 20% come from NATO countries. Or if you look at portfolio inflows in the US, right? Portfolio inflow in the US account for about 4% of GDP, 4.5%, while around 3% of that come from NATO countries. If you look at what share of dollar holdings as a share of US GDP, 30% of dollar asset holdings are from European countries. If you think about purchases as share. So there's a number of measures that shows how this rewriting international trade rules, international finance rules, will have significant implication for global portfolio flows. So if you look by asset classes, about a third of US Treasuries held by foreigners. If you look at equities, between 20 and 30%, whether you include private equity or not, is owned by foreigners. If you look at credit in the US, about 30% is held by foreigners. So there is huge implication of how other countries will engage and will try to reorganize their supply chain, their trades schemes, as well as portfolio flows with the US. Now, all of these create huge tail risk, right? There could be upside for some countries, but there are also possible huge downside in terms of the distribution of growth. If you look at where the effective tariffs are today relative to, say, pre-Trump administration 2, the effective tariff rate is about 17% now. There's different way to calculate this, but just to give a sense, this is way higher than it was pre-Trump 2 administration, and it's the highest level since the Great Depression in the 30s. One thing that has been quite interesting in this space is the fact that a lot of countries are not they are not reciprocated, if you want. One common feature of the 30s was that when the US would smoothly raise tariffs in the US, a lot of countries retaliated. And so that was an amplifier of the Great Depression. What we have seen here, we have not seen other countries retaliated, and we have seen countries trying to cut deals with the US. I think that is one possible reason why we have not seen the same depth of economic disruptions and slowdown that we have seen probably in the 30s. The game has been played differently. There has been a number of deals the US has cut with individual countries, and that I think has been an ameliorating factor in terms of the impact. I want to share one piece of research that we have done here at the Institute in terms of the tariff work that may be relevant. We have looked at the earnings call for the S&P 500 in Q1, Q2, and Q3 of 2025. We have done this employing Palantir platform in conjunction with Andersen Consulting. We work with them, and we took essentially 1,500 transcript of earnings call for the S&P 500 firms for 3 quarters. We ran LLM data on top of it, LLM models on top of that, so AI, and tried to figure out how US firms, so those 500 the firms in the S&P 500, reacted to tariffs. And so the things that came out from the work is that one is that of the 3 possible actors that may have absorbed the tariffs, which means foreign companies, US producer, US firms, or US consumer, foreign importers or exporters have not absorbed tariffs for the most part. So the $200 billion that US Treasury has raised has to be paid by someone. And so what comes out of our work, which I think is interesting, is that for now at least, the impact on consumer and consumer price has been relatively limited. Most of the impact has been inside the firms, and they've dealt with this in 2 ways. Either they absorb those in their margins, or they try to make their supply chain more efficient, possibly with the use of AI. So the question for markets then is there a point when firms cannot absorb more of these tariffs inside their margins? And if that's the case, we'll have to raise prices so the consumer will pay, or it will show up in their earnings. Now, we have probably reached peak tariffs. It's possible that a lot of the anxiety that we have seen before is going to go away. And so in that scenario, I think probably the peak impact on inflation is in the rear mirror. But I thought that what was interesting in the work essentially was trying to internalize at the firm level how individual firms are actually reacting to these tariffs. It would be interesting to see what kind of lesson, if that's a very unique US lesson or whether it can be translated to the rest of the world. The other thing I want to go back is the AI financing before I move quickly to the digital finance. I think there are 3 important pieces to remember of AI here. One is the scale of investment that they are needed, right? I already mentioned there's about $650 billion that need to be invested. So this is the second factor I think we're going to focus. Again, one was the geoeconomics or geopolitical tension. The second one is AI. This boom into AI capex, the drivers of AI boom are actually accelerating, right? If you look at the last 2 weeks, the announcement by Anthropic of Clay Code and particularly Clay Co-work has generated a huge amount of disruption in US financial markets. Investors started to rethink a little bit, or at least try to guess which sector have been affected, right? We started with software, and so the stock prices of software companies collapsed or dropped significantly, 20% since the beginning of the year. Then we moved to data analytics, tax strategies, even logistics. And so markets are essentially trying to guess which sector will be affected more by the AI disruption. We have seen significant volatility at the firm level that has been probably masked by volatility at the index level, but within the index, some of these sectors have seen significant volatility at the component level. We've also seen a rotation in US equity markets out of tech since October of last year into more traditional firms. Firms are more defensive, they're more on the cyclical side, right? On the consumer side, materials, energy, industrials. We also seen a rotation outside of the US more toward, in terms of performance, of equity in the rest of the world. So US equities have been outperformed by, for example, European equities, particularly Japanese equities, and importantly, emerging markets equities, very significantly outperformed by EMs. So now, how are they going to fund all this? And I think I asked this question because it's relevant not just for the US, but where is the capital that will fund the AI boom come from? Right now, particularly for the hyperscaler, the financing has come from free cash flow. Essentially, they ran such large, they had so much large free cash flow that they could actually fund the boom in AI capex, at least through part of 2025, using cash flow. And then the rest that would be used to do share buybacks. That is not possible anymore. Now we start seeing a very wide range of tools in terms of financing. So cash flows for those firms who have it, not everyone does, the hyperscaler primarily. They are tapping investment grade corporate bond market. Q4 investment grade bond issuance was very, very large in the US. They are also starting to tap private credit markets. We have seen a number of deals that have been announced between private credit funds, firms, and joint venture with the hyperscaler. So the combination of all these markets is starting to widen. The menu of options available in terms of credit markets is starting to widen quite a bit. And that has implication for where this is additional capital that is going into the AI boom, or whether this is capital that's being drawn away from other sectors as well as from other countries. I think one of the reasons we have not seen an outflows from the US in terms of equity investment, for example, or credit, after the Liberation Day in April, when the administration announced the huge spike in tariffs, is because people want to continue to invest not just in the US, but also in the AI trade. And if you want to be investing in the AI trade, you need to be investing in the United States. And I think that's where some of this capital pool will come from. And then at the end point, some of this firm, think about Anthropic, OpenAI, have announced an intention to essentially go public, to go into a public market at the end of the year, the IPO. And that has kind of reopened the IPO market and the M&A market, not just in the US, but globally. So I want to say a few words about the third factors that I mentioned, the digital finance. So digital finance for many years essentially meant Bitcoin and cryptocurrencies. Those are a very different animal, if you want, right? So early in the year, so when I was still at the IMF, we did some work trying to think, why would you want to invest at Bitcoin or similar cryptocurrencies in your portfolio? And the story a few years ago was that those currencies are where essentially a portfolio diversification effect they had. They were little correlated with other asset classes. So if you had some share of your portfolio invested in Bitcoin, essentially you benefit from a diversification effect. That factor, I don't think it works anymore. Bitcoin and other cryptocurrencies are very much correlated now to risk-taking with speculative behavior. And we have seen the behavior of Bitcoin in particular in the last few months, right? It went from 120 all the way down to 60 plus, losing almost 50%, and dragging down with it, not just Bitcoin, but similar currencies and all those firms that have invested heavily into Bitcoin. The firms that comes up all the time, it's like Strategy. That's a company, they call it Bitcoin treasury companies. They issue debt, they issue equities, they buy Bitcoin and lever themselves up. And as long as Bitcoin price continue to go up, the stock price of those companies goes up, they buy Bitcoin and they keep levering up. Now, unfortunately, that works also in reverse. When Bitcoin goes down, you start delevering and going down. And we have seen some of those effects in that sector. That's just one piece, right? So I want to separate the Bitcoin and cryptocurrencies from the technology underlying itself. That technology, it's a revolutionary technology that actually can be used in different segments of global financial markets. An example is stablecoin. Right? Stablecoin are the digital version of fiat currency. The US has invested past the Genius Act, essentially provide a regulatory framework for stablecoin. One of the goals stated is to extend the dominance of the US dollar in the digital space going forward. Those are one-to-one with dollar-denominated asset, low-risk liquidity like T-bills, bank deposit, money market mutual funds. And so the objective is to essentially create a digital version of fiat dollars that push forward the dominance of the US of the dollar in the digital space and create a plumbing of payments, digital payments that is based on stablecoin, dollar-denominated stablecoin. There are primarily two. The largest are two. There is one that it's Tether, that is mostly, we can find them in emerging markets. It has been used previously, particularly to move capital out of emerging markets, right? If you want to invest and take dollar exposure. And then there is another one that is has become more popular, that is growing in size since the passage of the Genius Act in the US. I would like to also highlight that the use cases of the use of stablecoin is changing. It's not just to invest in cryptocurrencies, right? Think about as the digital wallet to buy cryptocurrencies. I think the use cases are beyond that. You start seeing use cases where at the corporate level, for example, and this is why it should be relevant, this discussion for firms. Think about a treasurer of a company where in the past you used to invest, let's say, 20% in bank deposit and 80% in money market funds, right? This is management of liquidity, the daily liquidity. In the future world, that same treasurer could invest 20% instead of bank deposit in stablecoin and 80% in the tokenized version of money market fund. And that's the third venue of expansion of digital finance. You can take any asset class from equities, credit, government debt, and tokenize them, essentially bring them on the ledger. That's, in my personal view, that's the future where finance is headed. It's just a matter of time. You reduce the cost, the efficiency, you increase efficiency, you reduce the cost. It trades 24/7. It's secure. It's on the ledger. And there's a number of, for example, asset manager here in the US are already offering a tokenized version of money market funds or even risk asset, whether this is equity or credit. And there are even discussions of sandbox in some countries, the UK, for example, where government themselves may actually either issue directly a tokenized version of that or issue the traditional physical debt and then tokenize it on the ledger. That's another example. That's the third piece, if you want, of these three forces that are really reshaping global economy, global trade, and global finance. Now, where this emerging market fits in all of this, I think CM have benefited from the strong economy. I think they have, first of all, they have put in place a number of countries, they put in place very sound macroeconomic policies. They have strengthened their legal framework, they strengthened their monetary policy framework, and that has been evident in terms of the performance that the EMs had coming out of COVID. A number of emerging markets, particularly in Latin America, some European countries, less so in Asia, but they actually have hiked monetary policy proactively. That has actually helped to bring inflation down and create some policy space relative to the US that has been late compared to the emerging markets to hike monetary policy. And so when the Fed finally increased rates in the US dramatically, we have not seen the usual crisis, capital flows, outflows that we used to see in emerging markets when the Fed tightened. Part of it, I think, is because they actually very proactively tightened monetary policy before, and they put in place more credible inflation targeting regime that allowed to tailor monetary policy to their domestic conditions and utilize a more floating exchange rate as a form of shock absorber to absorb some of the shock. The other benefit, the factor that the emerging markets as a world benefit from has been the fact that the dollar is not appreciated as it usually would do when the US tightened monetary policy so much. The two factors that we used to look at when I was at the fund in terms of capital flows, the factor that would explain the behavior of emerging market portfolio flows were US real rates and appreciation of the dollar. The combination of higher real rates, stronger dollar, and more volatility in markets usually was bad news for emerging markets. Well, we have none of this, right? We have only one. We have higher real interest rates in the US. We have not had dollar strength. If anything, the administration here is pushing in the other direction. And volatility has been very, very compressed in global markets, despite all the uncertainty, policy uncertainty, macroeconomic uncertainty. So those easy global financial conditions certainly help emerging markets. A number of not just high-grade emerging markets, but also frontier economies, for example, have access to capital markets, and they've been able to actually tap global markets, albeit at higher interest rates. And then I think the last factor that benefit emerging markets is that in the geopolitical war, where do emerging markets locate, right? So traditionally, when you think about emerging markets, you think about oil producer or an oil importer and exporter, right? Based on where oil price go, a group of country in emerging markets benefits, another group of country in emerging markets suffers. The geopolitics of commodities change, right? Oil is not the only commodities now that are relevant. Anything that is like metals, anything that is like rare earths, and that focus on different segment of the commodities complex has actually kind of reshuffle a little bit the relative advantage and disadvantage of different emerging markets. And this is particularly relevant, I think, for Africa, for example, because some of these commodities actually are in Africa that raise the profile of some of the European of African countries in terms of the geopolitics. The question is, in some sense, for emerging markets, I think one is how do they fit into the geopolitical fracturing of the world, right? I think Mark Carney has a great speech at the World Economic Forum. In this hegemonic fight between, say, US and China, between large powers, there are a number of countries, what he called the middle power. And I think some emerging markets actually fit that description. And there's a choice there, right? Once you recognize that the old international order doesn't work as it used to before, you can either act independently, and then you're always going to be much smaller than the hegemons here, or you can start cutting different deals with different countries based on different segment, right? So what you call the variable geometry means that you can have specific deals on the commodity side with some countries, then you have some deals on the supply chain. And if the middle power act as a whole, as opposed to individual country, that completely changed the geopolitical interaction between the two hegemons. And I think that's an important factor for African countries to think about how to place themselves in the geopolitics of this new world. The second piece is what is the role of African countries in terms of global growth? I think Africa has one huge advantage, which is the demographic, that it's actually a drag in advanced economies, right? This is not just China, it's not just Japan, Europe, and increasingly so the US. So what is the role of African countries in terms of providing labor supply in the future, and how to make the labor supply at the time of AI that is relevant, though, that it doesn't become suffer from the downside of the AI labor replacement. And then there is the third piece, which is what is the role in the new world of digital finance and the payment system? How is the plumbing in Africa will fit into this new global plumbing? In some sense, it's going to be more fragmented, right? I don't know how much US dollar stablecoin will gain traction in terms of creating substituting for the traditional role of the dollar. But in a world where this plumbing is more fractured, where you have the digital euro, where you have stablecoin US, you have digital RMB, how to fit into this fragmented payment system and digital finance. So maybe I'll stop here. I think I gave you a huge marathon of all the forces here. So I'm happy to stop and take questions if anyone has questions.
A million thank yous for all the data that you rolled out. I would move from tariffs and trade into geopolitics, geoeconomics, different way of doing things, how, the AI boom dovetailed into digital finance, spoke about stablecoin, specifically the three forces, we've seen them. How is Africa going to plug into this? And even Nigeria. There are circa 200 people on this webinar, and I'm sure a number of people, having heard all the statistics and the data, would also like to get some kind of refinement on how it really affects us. Looking at I'm going to call it the Andersen flexibility, because right after I started the webinar, the next item on the agenda was actually to get opening remarks from our co-regional partner. But the speedy Gonzalez that I am, I just jumped right into it, and then I brought in Fabio. So to give some interpretation and further context on how this affects Africa and a segue into Nigeria, I'm going to bring on our co-regional partner now, Leah Dibi, to share a few words. Leah, my bad. Please forgive me. I'm bringing you on now. I know it's a bit ad-lib, but I trust you will deliver. Thank you.
Thank you, Baba. after listening to Fabio explaining the economic concept, there really nothing I want to say more than I think we can just go to question and answer straight. But just briefly to just talk about, as Baba mentioned at the beginning, this webinar is the brainchild of the five Andersen firm in Nigeria: Andersen Tax and Business Advisory, TMP Legal Services are known for M&A activity in mostly in the fintech industry. Andersen Consulting, no need for introduction, of now the traders Beraki. The Boston Advisory is on the investment banking arm of Andersen, and then we have Nelson Top Alonge, which is into valuation. So maybe to situate this in the way, I need to let you know that Andersen is in the reincarnation of Arthur Andersen is in 47 countries in Africa. We have the largest footprint of any professional service firm, so we can help our clients navigate any issue, any part of Africa without, have what we call a central location of provision of services, so that client doesn't have to contact all the offices. We can do that from a single office. So in Andersen, we are not saying we are better, but we say we are different. So maybe I would just call on Josh, Dr. Josh Bamford, to kind of throw a little bit of before we go to question and answer, some part of situating this as part of the how this, what Fabio has indicated, how it can be stressed in Nigeria, how do leaders kind of work around the global economic turmoil, if I would put it that way. So Josh, just briefly, if you want to just talk about that.
Larry, there isn't much I can add to what Fabio has said. When a senior economist talks, the economists just listen. But I think there's a lot of things that we can take from what Fabio has talked about. There's a major role for emerging economies, which Nigeria is a part of. The fact that Nigeria is a major player when it comes to one of the most important commodities, which is crude oil, and the other opportunities that we see, given the fact that there's been a huge shift in terms of supply chain arrangements. And when it comes to international trade, most jurisdictions are cutting deals either on the right or the left. And that creates opportunities just not for the jurisdiction, but for the key players within the economy, which includes the business sector. So for me, my takeaway would be the fact that this is a welcoming presentation. We have an opportunity to ask questions so that Fabio will be in a position to clarify some of these issues. But it's been very insightful. And as a student of economics, I've learned a lot. Thank you very much.
I spoke for half an hour. I ran you to this huge marathon of things. But if you are like a CEO of a firm or you run a financial institution, why would you care about all these big things, right? Those seems to be big forces. You're far away. I read them on the news, but why in the end should I focus? I think the reason why we need to pay attention to this is that if we use the old framework that we had before, so let's say pre-COVID, to think in terms of inflation, or to think about public debt and fiscal deficit, or more importantly, what technology means, how to think about supply chain. If I do cross-border business, how should I think about cross-border? If you think the old world business framework that, okay, we have these shocks, the US administration is trying to change a bunch of stuff, but eventually there will be a new president and we'll go back to the old regime. I think you'll be disappointed. I think a lot of these forces are here to stay. And when I mean forces, I mean the geoeconomics, obviously, but also the innovation coming from AI as well as the digital finance. All these forces are here to stay with us. So it is important to look forward and not in the rear mirror and say, okay, how did I respond to some of this before? Those are happening all now at the same time, and they're really changing the macro structure of financial markets, how the economy works, what we think about productivity, labor market. And so the best thing to do is trying to actually incorporate some of these forces and trying to think before they are much more difficult to manage. How to think about, for example, supply chain resiliency. What resiliency effectively means? How is capital markets changing? How am I going to access capital markets? How am I going to manage liquidity? Those are questions that are at the micro level, at the individual firm level, at the individual CEO. And those are very relevant questions that needs to be framed within this bigger forces of changing, but looking forward, not using the old framework of yesterday, because that framework of yesterday doesn't work anymore.
Thanks a million for that, Fabio. Interestingly, I've just gone into the Q&A platform and we have no questions. I don't know whether it's my iPad playing tricks on me because we've got about 183. All right. Something's come up now. I've just found one. And this is for you, Fabio. I don't know if you can see it. It's actually in the,
Yes.
Maya's just shared it with you.
Yes. So what are the defining global economic trends to shape 2026? I think more or less I think I answered those. I think the focus here is going to be on the geoeconomics, how this is going to play out. And again, a lot of focus now are the relationship between US and advanced economies, right? The Europe and the US, right? The Munich Security Conference, or the relationship between the US and Asian countries like Japan. But I think they're also highly relevant for emerging markets. I make the case how Latin America, for example, is going to be a point of interest, in particular for the administration. There's also refocusing on, and part of the trying to reduce the focus on Europe is also because of the transition toward Asia. That transition in terms of interest toward Asia, and Japan, Australia, all that part there, that started before, right? This is not a Trump administration move. It started with the Biden administration, with the previous Trump administration, with the Obama administration. You can go back as much as that. And so those forces, I think, are going to be there for 26, 27, 28. So those, to me, those three forces, innovation and AI, geoeconomics, and global finance, are the three forces that will reshape how we think about global trade, how we think about global economy, financial market. And I think the point is, where are the biggest inflection point? And this is the challenge here, right? That the cone of outcomes is so large that you can have significant downside risk, but also significant upside risk, right? I try to make the point with AI. It could be that this huge investment in capital don't turn out to produce returns as financial markets expect, and so there is a correction in equity markets and in credit market. Or it could be that adoption is non-linear, right? Once firms start to rethinking their system, rethinking about human capital means, and technology becomes not a substitute but a complement, it could be that there's significant non-linearity in the adoption of AI. And so this is why the cone of outcome is so wide, and why I don't like to use the word uncertainty here. So uncertainty is somehow you have a distribution of outcomes, and you can calculate more or less how wide the distribution is. I think part of the challenge here that some of the possible outcomes are actually non-predictable, right? This is such a game-changing technology. This is such an effort to rewrite the international order that it's really hard to predict. It's not about uncertainty around some model outcome, but it's about what can I predict? And that's why I started with the IMF forecast, because that thing has been little changed for a year or more, but under the hood, there are so many forces pushing in different directions that calculating what is the distribution of outcome, what are the inflection points, it's really hard, right? Because another point to make, I think it's important, these three forces don't operate as a silos, right? They interact with each other. So you can think how AI is not just an innovator. The AI innovation is not just in terms of productivity labor market, but AI is also a tool that can be used in geoeconomics, in the geopolitical confrontation between, say, the US and China. Similarly, digital finance can be a way to fragment the world into different payment systems, but the private sector also has the ability to actually circumvent this fragmentation by setting in place common pipes. And so this is why the question really to us is whether these forces are an amplifier of this geoeconomic fragmentation, so they make the fragmentation even more evident, or both AI and digital finance can actually be used at the individual firm level to actually absorb some of the shock and bring in efficiencies. That, I think, is the right way to ask the question. I think fragmentation is here to stay, no matter who's the next administration in the US is. This has put in motion a change in looking at the world away from the international order, from international cooperation. The fragmentation is here to stay with us. The issue is whether the other two forces, technology, innovation, digital finance, will amplify these shocks, or will actually be shock absorber that allows you to actually manage in a more efficient way this new world. There's another one that is about how should business leader interpret the current monetary policy cycle. Okay, I didn't go much into monetary policy. I'm happy to do it. I think we have moved away from a more synchronized monetary policy cycle, more differentiation, right? So during COVID, every central bank in the world cut interest rate very aggressively. And then when inflation starts showing up with high prints, we have seen central banks globally start hiking interest rate. There was some delay. Emerging markets went first, particularly Latin America. The Fed followed the ECB, advanced economies. But there was some sort of directionality was common toward hiking interest rate. Then we went into this reducing interest rate again. The Fed cut interest rate by 175 basis points. Advanced economies cut. Some emerging markets cut. But now I think we are at a point of divergence. We can see some countries hiking. Think about Japan, for example. In the US, the Fed markets have 2 more cuts priced for this year. My personal view is that inflation is going to turn out to be stickier than markets expect. So it's possible the Fed is going to cut little. Obviously, it's going to be depending on what productivity does. But there are other countries where inflation policy is moving the opposite direction, right? So take the Reserve Bank of Australia. They cut into a labor market that was already tight because inflation was coming down. They were forecasting inflation to continue to come down. Well, that didn't happen. Inflation seems to actually turning up again, and they had to start to hiking again. So we're starting to see much more divergence in the monetary policy cycle within advanced economies, within emerging markets, and across countries as well. The number 3 is like in an era of geopolitical fragmentation, how should emerging economies strategically position themselves? I think I kind of answered that question. I don't know if there's more in-depth question for that. But I think I try to provide a view how emerging market can position themselves in this new world. There's a question on the outlook for the US dollar as the dominant reserve currency and whether to hedge FX across border exposure. I think it's an intent of this administration to have an easy dollar, right? I think it's been quite evident now. At the expectation most economists had in April of last year when they announced the significant hike in tariffs was the dollar would appreciate. And in fact, we have not seen that. I think we have seen a divergence between the behavior of the dollar and capital flows. So normally, you would expect that if people were running away from dollar asset, the dollar could depreciate because people were essentially selling dollars to buy other currency and bring money home. But we are not seeing portfolio outflows other than for a short period in April. In fact, we continue to see significant inflows of portfolio flows into the US, including equities. And I think from anecdotal evidence, what a number of firms are starting to do are starting to hedge their FX position. So they continue to invest into, say, US equities. They want to stay with the high trade, but they don't want to have the same extent of exposure to the US dollar. So what they do, they increase their hedge ratio. That means for a higher share of the dollar exposure, they go into the derivative market, FX markets, and they hedge their position, essentially. That seems to be a common theme across firms across the world with different intensity. And then there's a question on, in a highly volatile environment, how should organization rethink capital allocation, portfolio optimization, liquidity? I think kind of answer the question. I think you need to build resilience. That's the word number 1. I think adaptability and resilience are the 2 words you want to take home. You need to be more adaptable to the very rapidly changing world, whether this is technology, whether this is geopolitics, or whether this is digital finance, and you need to build resilience. You need to build resilience because you need to be able to absorb some of these shocks. And again, the big question is whether AI and digital finance turn out to be an absorber of the shock, so I'll help you absorb the shock, or they will be amplify the shock. And that's going to be a function of how adaptable your firm is, how much resilience has been built in terms of portfolio, capital allocations, capital management, as well as liquidity.
Okay, I've got one more for you, and I know time's almost gone, but I'm going to throw this your way. The question is, how should organizations integrate climate transition risk, geopolitical security concerns, and regulatory shifts into long-term strategy?
That's a tough one. I think the unfortunate, if you want, collateral damage of all the discussion I had so far has been the focus on transition, right? On climate resilience. If you look at what has come out, for example, of at least my interpretation of the German Chancellor's speech, at the Munich Security Conference is a complete reprioritization of reordering of priorities, right? Priorities number one now is we need to build security, supply chains. Number two now is we need to move toward more growth. We need growth, less bureaucracy. Growth is the way out of this. And then third, essentially, are the priorities related to climate change and climate resilience, right? A softening of the requirements for sustainability, reporting, and so on. So I think, unfortunately, that climate resilience has been lowered in priorities in a number of countries. When you put a choice between security and obviously supply chain security and climate resilience and adaptation, a lot of countries have gone in favor of securities. They move towards securities. So I think we need to find a way to actually bring that from the bottom, from the below priorities now all the way up, but do in a way that is not in contrast with security. If you force any countries to choose, do I go down the security path? Do I use money for security and supply chain and resilience? Or do I use money to invest in climate adaptation, climate resilience, and transition? I think obviously if you have to choose, you choose securities. You have to. The way to, I think, to solve this problem is to make sure that if you invest in climate adaptation, resiliency, that is not in contrast with securities, but the two objectives actually can be aligned. And so moving away from dependency on oil on some countries from a geopolitical standpoint and increasing investment in renewables, it's something that you can do at the same time as you're trying to increase your security. At the same time as you're trying to come up with new source of energy for data center for AI. So that renewable energy needs to play a role, not just because we want a better planet for our children, grandchildren, but also because it can be a source of resilience from a security standpoint. You don't depend as much from some countries, and also from generating enough supply of energy that is needed for investment in AI. If you reprioritize this way and tell the story this way, I think then we can bring up, again, in terms of priorities, the transition. If this is framed as a narrative as one, security or transition, I think I'm afraid that transition will lose, which is a little bit what we have seen so far in the last few years.
To the participant who asked a question, I hope that sufficiently addresses the points that you wanted raised by Fabio. Fabio, we're spent for time. We're almost at an hour. We plan to have this for just 1 hour. I think we've done about 56 minutes so far. My job practically is done, and I'm going to hand over now to another managing partner of one of the, as I said, the five fingers of Andersen in Nigeria. I'm handing over to the person of Niyi Yusuf of Veraki, which is Andersen Consulting, to give some remarks. Thank you very much, everyone.
Thank you, Baba, and thank you, Fabio, for what I think has been an excellent session. I see there are quite a number of other questions in the Q&A window that has not been answered. And I think the commitment of Andersen is that we'll send all these other questions to Fabio, and before the end of the month, there will be written responses to these questions that are in the Q&A. But I mean, thinking about the last hour, I think for me, the key messages really is around adaptability and resilience. There are global forces, there are global trends. And from Fabio's perspective, from the Andersen perspective, these global forces are here to stay. They are not transitional. And it's difficult to predict what will happen, given that all these forces are, in multiple ways, they are connected. Geoeconomics, geopolitical risk, artificial intelligence, digital finance, they are all connected. So they present unpredictability, but they also present opportunities. So our role as business leaders is to incorporate these forces in a forward-looking manner into our strategies going forward. So I'd like to thank all participants for what has been an engaging session, given the quality of the questions in both the chat forum and also in the Q&A. Thank you for your attendance of this session. This is the first in more sessions to be held by the 5 Andersen member funds in Nigeria. We also will be sending to you all in the next few days a survey. So we'll ask that you please help us respond to the survey, to give feedback about today's event and also about other topics you'll be interested in. Leah has promised that if we need Fabio to come to Nigeria for another event, physical session this year, you'll be glad to do that. So thank you, Fabio, for sharing your Tuesday morning with us. I know it's AM where you are in US, but more importantly, thank you for sharing the global perspectives and how it affects businesses on the continent. I would like to end by thanking all the Andersen firms in Nigeria for their support for the planning process and for today's event. But most importantly, let me thank all our clients, our partners, and our friends for joining us at today's session. So I wish us all of rest of the evening. For those who will be fasting tomorrow, Ash Wednesday starts this week, and also for the Muslims, Ramadan starts this week. So for everyone, wish us all a blessed week. And thank you, everyone. Have a good rest of the evening.
Bye-bye.
Bye, and thanks for being.
Bye.